Okay, so this is the second question what we have on the basic investment appraisal techniques, that is your ROCE, return on capital employed, and the payback period. Okay, and after solving this question, we will see a couple of MCQs with respect to these topics. Okay, so if you look up at this question, which is food company now, it says that it's a food manufacturer and it's considering investing in two new ranges, which is your luxury meals and savory pies. So basically, you have two different investments over here, and you are supposed to evaluate them. Okay. So one of them is the luxury meals. You can see the information for the luxury meals investment is given over here. And then you have the other one, which is the savory pies investment, and the information for that is given in this part of the question. What are the requirements? So they ask you to calculate the payback period for the luxury meals investment. That's your first requirement. And the ROCE, or the return on capital employed, for the savory pies investment based on the average investment. So that's going to be the second part of your requirement. And then you also have to comment on the acceptability of the both the projects referring to the criteria set by the company. So let's see what's the criteria being set by the company here. Okay, but before this, you can see that both investment projects have an estimated life of 4 years. So basically, the life of the project is 4 years for both of them, and they have two criteria for selecting investments over here, which is ROCE and the payback period. And the criteria set by the board is they need an ROC of more than 30% and the payback of less than 3 years, right? So they do have the luxury meals ROCE, which is 27.9. However, they want us to calculate the savory pies ROCE, which was part B of the question. So this is part B of the question. And the payback for the luxury meal that was required, and that's part A of the question. And then you need to comment onto it, okay? So if I look up at the luxury meals from the ROC perspective, it's not going to be approved because they need an ROC of more than 30. This one is at the maximum of 27.9%. So this is not going to be accepted from the ROC criteria. However, from the payback period, the savory pies will be accepted because the payback is less than 3 years. Okay. So now this is the information they have given with regards to the luxury meal investment, and we need to calculate the payback. So while you're calculating the payback, okay, so we'll just write down the heading. That's the payback, uh, payback period for the luxury meals investment. Okay, so we need the cash flows, right? And as we know that the life of the project is 4 years, so we need to open up 4 columns, right? Right. Okay. So now you can see the demand they have already provided to you at 500, 720, 800, and 850 sales or meals per year. So I will just simply write down the demand over here, which is 500,000, 720,000, 800,000, and for the fourth year it's 850. Okay. Right. So that's the demand. The selling price, because the first thing what we need to do is that we need to see the sales revenue and then the variable cost, right? Or you can club them together and you can find contribution. And that's normally preferred just to save time in your exams. So you can see here that the initial investment is those 7 million. At the end of the 4 year, we will get a residual value of 1.2. Selling price in year one price term. So in year one, in price, in money terms, it's going to be 14. But then you can see that there is a rate of inflation at 10% for the second year, 6 and 0 for year 3 and 4 respectively. Okay. So as far as the selling price is concerned, it's going to be 8 per meal in the first year, but then you have to inflate it by 10%, right? So 8 into 1.1. So we get, uh, sorry, it's 14 selling price. So here we have to take 14, and this will be inflated by 10 percentage, so 15.4. Yep. And then the next year rate of inflation is 6, so 15.4 into 1.06. Okay. And fourth year we don't have any inflation, so we'll keep the price constant at 16.324. As far as the variable cost is concerned, it's 8 per meal in the first year. So we'll just have to take 8, and then it's inflating by 8 percentage in the second year. So this will be 8 uh, inflated by 8 percentage. So that's going to be 1.08. Okay. So that's 8.64. Then you need to inflate it by 5 percentage. So 1.05. So that will become 9.072. And in the fourth year, it's going to be at 4 percentage. So we will take 9.072 into 1.04. Okay. So that's the variable cost for the fourth year. So if I just subtract them, I'm going to get the contribution per meal, and I can just simply multiply it by the demand, and I'm going to get the total contribution in the exam. I mean, you can do the sales revenue separately and then the variable cost, and then you subtract them and you will get the contribution, or you can just do it in one single step where you calculate the contribution per meal after the inflation, which is 6 in the first year. And if you just simply expand it, you will get it for second, third, and the fourth year. Okay. And if I multiply it by the demand, I'm going to get my total contribution in dollars. Okay. So it's going to be 6 into 500,000. So that's like 3 million. Okay. And for the upcoming years, we just need to expand it and we will get our total contribution. So far, so good. After total contribution, what you have to do is that you will subtract your total fixed cost so you can get your operational cash flows. Okay. So in this case, the fixed cost, incremental fixed cost in year one price term is 1.4 million. So I'm going to write down 1.4 million, but that has to be inflated by 7 percentage every year. So what I'm going to do is that I'll take 1.4 million and I'm going to inflate it by 7 percentage. So I'll multiply it by 1.07. So it will become 1498000. And if you can just simply expand it, you will get it for year 3 and 4 respectively. As far as the operational cash flows are concerned, you have to take the total contribution and then you can just simply subtract the fixed cost and you're going to get the operational cash flows, right? And you can just simply do it for the second, third, and the fourth year too. Okay. Now, if you look up at this question, because when you're calculating the payback, you also need to incorporate for tax, because the net cash flow which we will get will be after the payment of tax. And in this question, you can see that it says that the company pays corporation tax rate at a rate of 22% in the same year in which the profit arises. Okay. So that's important information over here. So tax will be at the rate of 20%, 22 percentage, sorry. Yeah. So what you simply have to do is that you will take your operational cash flows and you will multiply it by 22. So you get this tax payment for the year one. And likewise, you can do it for all the upcoming years, right? And this is going to be after tax operational cash flow. Okay. So once you have done this, you can just simply subtract the tax payment and you will get your answer. So I just have to take 1.6 million. Okay. Yeah. Minus the tax payment. So I get this, and I can just simply expand it, and I'm going to get for year 2, 3, and 4. Right. Okay. So in the last year, the fourth year, you will also receive the residual value. Okay. So the residual value will be in year 4 worth 1.2 million. So here we go. And this will give us the total cash flows. So for the first year, it's quite simple. It's going to be after tax operational cash flow. For the second and the third year, it will also be same. However, in the fourth year, you just need to account for the additional 1.2 million, and it will give you a total of this, which is 4.429739 million. Anyways, so now once we have got our total cash flows, things are very easy. Now we can find out our payback period. Okay, just set it in a proper format. So year 0 is where we have invested 7 million. Here you can see that there is a initial investment of 7 million. So we will write it down 7 million. Year 1, you got a cash flow of this much. Okay. In year 2, you got a cash flow of this. In year 3, you got a cash flow of this. And in year 4, you got a cash flow of this. So all the cash flows, whatever you have calculated, you just need to bring it down in a proper format, and we'll just label the years, right? And here you have to make one more column, that is for the cumulative cash flows, because you can see that the cash flows are different every year. Okay. If the cash flows would have been constant, I would have just simply taken the initial investment amount divided by the cash flow every year, and I would have got my payback period. But in this case, because the cash flows are different, I just need to make up one extra column over there, and I will accumulate that how much cash flow is remaining. So at year 0, I have invested 7 million. Okay. But then in year 1, I got 1.248 million. So now after getting that, I'm still in a deficit of 5752000, basically 5.75 million. Okay. But then the next year I got 2.6 million something. Right? So I'll take this figure, and then I'll get 2.6 million. So this is still, I'm in a shortfall of approximately 3 million. But next year, you can see in year 3, I'm getting above 3 million, like 3.27 million. So I will be in a positive. So this plus this. So you can understand that it at least took you like around 2 years completely and 13 months to get you to your payback. Okay. And in the fourth year, we are in further surplus of this much, which is 4.58 million, right? So it's basically 2 years for sure, and then a certain number of months, because here now you see that the answers are in decimal 2.4. So we need to give the answer in decimals over here. And for that, what we have to do is that we will see that after 2 years, we were in a negative of 3.12 million. But the next year, what we are getting is 327. Okay. So this indicates that it will take approximately 0.95 of the next year to cover up your negative balance, which was by the end of the second year. Okay. So if you need to get your answer in months, you just simply need to multiply it by 12, and you will get approximately 11. So if you want it in decimal, your answer will be 2.9695 basically years. But if you want your answer in months, so it's going to be 2 years and uh, 11 months approximately. Okay. So that's the payback for the luxury meal investment. Okay. So I will just bold it up. right? Yeah, good to go. Okay, so that's the payback. Now, if you evaluate it, it's less than 3 years. Okay, so I mean, as far as the payback is concerned, the luxury meal is actually fulfilling the target, that it's less than 3 years. However, if you see that savory pie is much more giving the investment back in a fastest way. Okay. So if I have to decide between luxury meal and savory, I will go with the one which is giving me a lower payback. So for the savory pies, it's 2.4, but here it's approximately 3 years because it's 2 years and 11 months. So the savory pie gives you a more quicker payback period as compared to the luxury meal. However, if you compare it with the target set by the board of directors, both of the projects would be acceptable because both of them report a payback of below 3 years. Okay. So now once we have done with the payback, now we can find out the ROCE for the second part of this question for the savory pies investment. Okay. So here we can go. ROCE for the savory pies investment. So when you're finding out the ROCE, you need the profits. You don't need the cash flows actually. Okay. And you need to see that what's the question giving you. So if you look up at this question, they have given you the cash inflows. Okay. I mean, it's before tax, so it's good because in ROC we use the operating profit, so we use the profit before interest and tax. So there's no tax impact for this savory pies investment because in ROC we take the profit before interest and tax, right? So we don't have to incorporate tax into it. However, you can see that this information is given to you in inflows. So if it's in your inflows, I need to convert it into the profit actually. Okay. You can see that we are talking about your inflows over here. Okay. So this one, that's the important part. So if it's in inflows, we need to convert it into profit. And how we will do that? By just subtracting the depreciation. Okay. So I'll write down total before tax net operating cash inflows. So that's approximately around 9 million. Okay. That's for the 4 years, right? Total. The depreciation which you will charge in 4 years will be called as your depreciable amount. Okay. You can do the question in two different ways over here. Okay. So, okay. So the depreciable amount is basically your total cost of the asset, which is 5.2 million and minus the residual value because that's the amount you will not depreciate, right? So this will give me the depreciable amount. So this is first way of how you can attempt this question, that you can just simply take all of your operational cash inflows before tax and you just simply deduct the depreciable amount. Okay. So this will give me approximately 4.6 million. So that's your total profit before tax from the investment. And if you just divide it by the number of years, you will get your average profit before tax. Okay. That's the one which we require for the ROC calculation. So 4.6 million divided by 4 years, I'm going to get 1.15 million. However, so this is basically you're doing it as per the method one. This is the method two. So instead of taking in total, I mean, you can just, that 9 million, you can just simply divide it by 4 years. So per year, cash inflow on average is 2.25 million. and then you can also calculate the depreciation for 1 year. Okay, so for that you have to do 5.2 million minus 800,000, and then you can divide it by 4. So that's also one way. In the method one, I've taken all of the variables to calculate the ROC, the profit in total. But in method two, you can see that I've just taken the average of, like I've taken the information on an annual basis. So on an annual basis, the average profit before, sorry, the average cash inflow would be 2.25 million. The depreciation charge would be 1 million. And then if I can just simply take my operational cash flows and I deduct the depreciation per year, so I'm going to get exactly the same answer. So either you can keep in total and then you divide by 4 to get the average, or you can just simply, from the starting perspective, you can just take every information on an annual basis. So then you don't have to divide by 4 to get the average. Okay, so whichever suits you. However, now we will have to find out the average investment. And for that, what we have to simply do is that we have to take the cost of the asset, which is 5.2 uh, million plus the 800,000, which is the residual value. And then we can divide it by 2 to get the average. So that's approximately 3 million. Okay. So to calculate the ROCE, we just have to simply take our average profit, which was 1.15 million, divided by 3 million, which is our average investment. And we get the answer in percentage form. So that will give me an ROC of 38%. So it's more than 30 percentage, and therefore it would be accepted by the board. Okay. Right. So now, as far as the commentary is concerned, okay, so from the ROC perspective, so from the ROC perspective, right, uh, Savory Pies investment would be accepted as it generates more than 30 percentage ROCE. Okay, more than 30 percentage ROCE, uh, which is the set criteria by the board, and as well as higher than ROC of the luxury meals investment. Okay, so from the ROC perspective, it's going to be the Savory Pies investment will be considered. As far as the payback is concerned, uh, for the luxury meal, it was 2.9 something, 2 point, yeah, exactly 3 years. You can approximately 3 years. So in that case, also the savory pies will also be selected because it's meeting the criteria set by the board, and it has a fastest payback period in comparison to the luxury meals. Okay. So from the payback period perspective, savory pies investment will be uh, will be preferred or selected will be selected as it has a payback period of less than 3 years and also a quicker one in comparison to the luxury meals investment. Okay, and you can just give up a conclusion that savory pies investment would be financially acceptable as it fulfills both the basic investment appraisal criterias. Okay. That's all in this. Okay, so now once we have completed this question, as we have completed this part, we can move towards the MCQs. Okay, so here we go. Now, see, which two of the following statements about the investment appraisal methods of return on capital employed and payback are true? Basically, there are two answers over here. Both methods are affected by changes in the cost of capital. Now, ROC and payback, they don't consider that what's the cost of capital. Okay, so that's basically NPV, IRR, and the discounted payback. So the discounted cash flow techniques are affected by the cost of finance or the cost of capital. So ROC and payback have nothing to do with the cost of capital. So that's wrong. ROC doesn't take account of returns over the entire life of the project. That's also false because when we were doing the ROC, we actually saw that how much returns, accounting returns were being made in the entire life of the project. So that's also wrong. The payback method is based on the company's cash flows. Yes, for the payback, we need the cash flows. For the ROC, we need the accounting profit. So payback, this statement is correct. And a requirement of an early payback can increase a company's liquidity. Yes, correct. Because the sooner I will get my initial investment amount, the liquidity will be improved. Because if your investment amount is stuck for a larger period of time, for a longer period of time, then obviously the company would have the liquidity issues. So as far as this question is concerned, C and D would be the correct answer. Okay. For the second one, they have asked you to find out the return on capital employed. They have just given you an extract. They have given you three profit figures over here. One of them is profit before interest and tax, before taxation, and after tax. So when we are calculating the return on capital employed, you have to use the operating profit, which is profit before interest and tax. So we will use this 2.5 million. And as far as the capital employed is concerned, it actually means the total of financing of the company, which will include your equity as well as the non-current liabilities. So in this case, your ROCE will be 2.5 million divided by 12.5 because it's 10 million is your equity and 2.5 is your non-current liabilities. Okay. So this gives me an ROCE of sorry. So this is going to be 2.5. Oops. Okay. So here also. Yeah. So this will give me around 20% ROC for this company Peach. Okay. Now, if you look up at the third question, it says a company undertakes a project that involves purchasing machinery at a cost of 65,000. It will be used on the project for 4 years, right? Generating operating cash inflows of 20,000 per year. It is sold at the end of the project for 10,000. Taxation is charged at a rate of 30%. Now, I don't need the taxation because I'm just asking you the question is asking you the ROCE, the initial ROCE for the project. Okay. So we don't need the tax rate over here. That's just pure confusion. You just need to see that what's your profit before interest and tax. But in this question, they have given you not the profit, they have given you the information is in cash inflows, right? So your cash inflows are 65,000. Okay. And the depreciable amount uh, is so that's basically the cost of the asset, right? 65,000. Operating cash inflows of 20,000 per year. Fine. So that now if they have given you in year, so what we can simply do is that we can just take 20,000 per year and we will calculate the depreciation for 1 year. So that's going to be 65,000 minus the residual value, which is 10,000. And then you can divide it by 4 years, which is the life of the machine. So the depreciation is 13750. Okay. So the profit would be 20 minus 13,750. That's your PBIT for 1 year. And so I'll just write down the names of it also. This 20,000 was basically annual cash inflow. Okay. And 13,750 was your depreciation per annum. If you deduct, you will get your profit before interest and tax. And that's what we are basically going to use for the ROC calculation. The initial amount invested is 65,000. Okay. So the ROCE to the nearest whole percentage. In that case, 6250 divided by 65,000. So you get 9.6. So you can approximately at 10 percentage if you round. Okay. So 10 percentage is basically the answer. Right. So now the next question you have in relation to the return on capital employed investment appraisal method, which of the following statement is correct? It leads to a better investment decision since it uses accounting profit rather than estimated cash flows. No, profits have a problem. You can manipulate them. They depend on accounting policies. So it doesn't lead to better investment decision at all. That's still a payback, but not ROC. Investment projects with the ROC greater than the weighted average cost of capital should be accepted. So if the ROC is greater than the average cost of funding, the project should be accepted. Okay. Investment projects with the ROC less than the current ROC of an organization should be rejected. And they say the ROC takes into account all years of operation of an investment project. Now, see, uh, as far as second statement is concerned, which says investment projects with a ROC greater than the weighted average cost of capital should be accepted. That's basically we are trying to talk about the internal rate of return. So if the internal rate of return is greater than the cost of capital, then you are supposed to do the project. Okay. So it has nothing to do with ROC basically. For the third point, investment projects with a less ROC less than the current ROC of an organization should be rejected. Not necessary. I mean, as far as the ROC is positive, I mean, you should still do the project and you can still look up at the net present value of that project. So it's not necessary that you will always reject it out. Okay. However, the fourth statement is correct because it says ROC takes into account all years of operation of an investment project. So yeah, we did consider the profit earned like in the entire life of the investment. So if it was for 4 years, let's say in the previous question, we actually saw the entire 4 years basically. Okay. So in this case, the option would be D. Okay. Right. Now, here they have a project has an average estimated cash inflows of 3,000 per year. That's good. They have already given it to you, the average cash flow of 3,000 per year with an initial investment of 9,000. Depreciation is straight line with no residual value and the project has a 5-year life. So the targeted ROC is 15 and the targeted payback is 2.5. ROC is based on initial investment. Okay, so let's find out the ROC first for this question. So as far as the ROC is concerned, uh, you just have to deduct the depreciation because the cash flow is already given to you. So the depreciation will be 9,000 divided by 5 years. So the depreciation per year is 1,800. Okay. And the cash inflow per year, that's 3,000. So I need to find out the profit. So I'll take the cash inflow and I'm going to subtract the depreciation so I can get my average profit per year. And as the invested amount is 9,000, okay, and the question says you that you have to calculate the ROC based on the initial amount invested, okay. So in this case, the ROC will be 13 percentage, which is below the target of 15, and therefore you are not supposed to accept this investment. It doesn't meet the criteria, okay, because it's less than 15 here. We have a target of 15. However, as a target payback of 2.5 years. So now we can try for the payback. Okay. So because you see now you can use the formula over here. I mean, you don't need to make up the table of cumulative. Every year you're getting a cash flow of 3,000 and you have invested 9,000, right? So in this case, the formula is 9,000, the investment amount divided by every year cash inflow, which is an annuity or which is constant, and that's 3,000. So in that case, the payback will be 3 years. So none of the criteria is being fulfilled. So neither. Under which investment appraisal methods using the company's targets will the project be accepted? So it's going to be neither one or neither two because the ROC is 13, which is less than 15, and the payback is 3, which is more than the target payback of 2.5 years. So in this case, the answer would be D, neither one nor two. Okay. Right. So here we have another question, which is from section B type of questions. Okay. Uh, in the first part of this question, they're asking you the payback, then the return on capital employed, and then the theoretical one. Okay, so let's try the theory first. Which two of the following statements about investment appraisal methods are correct? So normally, if I would have been in your position in the exams also, I normally look up at the theoretical question and especially those which are not related to the scenario. If it doesn't relate to the scenario, I mean, you don't have to read the scenario and you can just simply attempt those type of questions. Okay. So the return on capital employed considers the time value of money. Big no, because it's a basic one and the basic methods don't consider the time value of money. Right. Return on capital employed must be greater than the cost of equity if a project is to be accepted. Uh, Not really, because return on capital employed must be greater than the cost of equity. Basically, it's all about NPV. So if the NPV is positive or the internal rate of return is greater than the cost of equity or the weighted average cost of capital, then we have to accept the project. Riskier projects should be evaluated within a shorter payback period. Yes, because if it's riskier, so we want the payback as soon as possible with a shorter payback period. Payback period ignores the timing of cash flows within the payback period. Okay. Yes, it ignores the time value of money. So it ignores the timing. So this statement is also correct. So it's going to be C and D for the third part of the question. However, we can calculate the payback and the ROC for this project. Okay. So as far as the ROC is concerned, sorry, as far as the payback is concerned, that's the first thing. You have invested 3.9 million. Okay. So here, and the project information relates to an investment project which has been evaluated by the directors of Fin's company, a listed company. The initial investment payable at the start of the first year of operation is 3.9 million. And then these are the operating cash flows, what you're getting. So in the first year, I'm getting 1,200. The second year, I'm getting 1,500. Third year, it's 1,600. And the fourth year, it's going to be 1,680. You will also get the scrap value, right? So I just need to do the cumulative cash flows. So it's going to be 3,900 negative plus 12. Okay, so let's keep this yeah, here. So negative 3,900 plus 1,200. So you got negative of 2,700, 2.7 million. Then you got 1.5. So Still you are in negative by 1.2 million. But yes, next year you got 1.6. So now you are in a positive of 400. And obviously by the end of the fourth year, it will be 400 plus 1680. So 2.08 million. So in this case, you can see that this is basically 2 years have gone. Okay. And for the decimal, to two decimal places. So what you're going to do is that you need 1200 negative, but the next year what you're getting is 1600. So this will give you an answer of 0.75. So basically, if you want, as the question is asking you to calculate it in the month of, to calculate it in decimal, so it would be 2.75 answer. However, if they ask you in months, so it's going to be 2 years and 9 months, because 0.75 is basically 9 months of the year. So 9 months. So it's simply that what you're going to do is that you will multiply this 0.75, which you got, with 12. So you will get the answer in months, which is 9 months. So that ends up with the first part of the question. Then they're asking you, based on the average investment method, what is the percentage return on capital employed to one decimal place? Okay. So here the target is 15 percentage. Okay. And we need the ROCE, right? So what we can simply do is that we will see the operational cash flows, what we are making in all the 4 years. So it's 1200 plus 1500 plus 1600 and then plus 1580. So the total net operating cash flows what we are making in 4 years is 5980. This is the total operating cash flow in net terms. Okay. The depreciation will be 3.8 because 3.9 million is the cost and 1 million, 100,000 is the scrap value. So the depreciable amount over here will be 3.8 million. So 3900 minus 100. So it's 3800. So if you want to find out your total profit, you just simply need to uh, deduct the depreciable amount from the operating cash flows. And if you divide it by 4, you will get your average profit, which is 545,000. That's my average profit. Okay. And how we have to calculate the ROC is based on average thing. So for the average investment, we just have to add up 3.9 million plus 100, the scrap value, and then divide by 2. So we'll get 2 million basically. So if you want to find out the ROC, it's going to be 545 divided by 2000 or 2 million. So you get 27.25 percent. Okay. So that's going to be the ROCE. So ROC based on average investment. Okay. So here just you need to correct this. It's 1580. So yeah, 26 percentage would be your ROC in this case. Okay. And as we already discussed that for the part C, the answers would be C and D. Okay. Right. Here you have a very small theoretical question. It says, suggest three problems which arise with the use of average return method for appraising new investments. And then in view of the problem associated with ROC, why do companies continue to use it in project appraisal? So basically, for the first part of this question, uh, three problem which arise with the use of average return um, method for appraising the new investment. Okay, so obviously the first problem is that it doesn't considers the time value of money. Okay. Second, you can say that it is based on the accounting profits and not on the cash flows. Accounting profits are subject to different accounting policies and also subjected to manipulation. Okay. And it doesn't help to indicate or give a clear signal as to whether the investment should be pursued or not. Okay. And you see, if I just like to try to make you understand one thing over here. See, for this part, if I would have done it on ROCE based on initial investment, okay, then in that case, the initial investment over here was 3.9, right? So your profit was 520 divided by 3.9. So in that case, it's 13. So if I do it on average investment, you can see the ROC is going up. Okay, so that's also one problem. By using the average investment, the amount of investment will be lower, therefore artificially increasing the return on capital employed. So from the initial perspective, you can see it's only 13%, but just because, you know, I just use the average. So immediately it increased up by 13%. So these are the problems of using ROC. And but still, why the companies still prefer it? Because why do companies continue to use it in a project appraisal? Obviously, because it's simple uh, to understand and calculate. Okay. It's simple to explain it to managers which are not from financial background. Okay. And the information which is required to calculate is already available from the income statement and the balance sheet. The information required to calculate the ROC is readily available from the financial statements. Okay. It can also be used as a screening tool uh, before the investments are further evaluated using the DCF techniques, like the discounted cash flow technique. So it's just like a basic way, a basic investment appraisal technique. So if the ROC is fine, then only we will submit it for further evaluation. If the ROC is not fine, then I mean you can just simply reject the project too. So still, if it's been used by the companies, it's because of its simplicity, because of its easy to use, easy to calculate, easy to explain. Information is available, so no problem, no not too much uh, complications in calculating like how you would face for the NPV calculation. So yeah, that's why it's still going to be preferred as a as an investment appraisal technique. Thank you very much. If you have any question, please feel free to ask.